Welcome to Buffeting, the podcast where my wife Cass
Ew.
and I share our conversations on investing with you as we try to keep compounding capital so I don't have to go back to being a carpenter.
And I don't have to go back working with real estate agents. We hope you find it informative and entertaining.
But we are not your financial advisors and nothing we say should be taken as investment advice. As always, do your own research, which is more fun.
And now, without further ado, on to the episode.
Hearing the experiences of people who are older than you, who have been through these periods, and when Buffett and Munger say, yeah, this is the craziest time we've seen, like, listen to what they're saying.
It's like your brain was in an isolation tank
Yeah.
for like the first 25 years of our life.
Yeah.
Like it was only fed specific nutrients and grown in a specific way. Like it wasn't allowed to figure things out for itself.
Yeah. We've been throwing around a few different ideas as to what we're going to talk about for our next episode. But I think the thing that we wanted to talk about was how we're handling what looks like, from everything that we've read, from everything that we've read about history and the current moment that we're in, what looks like a proper bubble.
It kind of overshadows everything you try and do, doesn't it?
Yeah.
So it's like, we'd love to just sit here and look at companies and do valuations, but
Yeah.
you run into like the same problem every time. It's like, wow, this is crazy overpriced. Next.
Wow.
So
Oh, hey, Bubby, this is also crazy overpriced. Next, so at some point, like, the fact that you want to look at things from a bottoms up point of view, it is influenced by the top down point of view.
It is. So let's just talk about it. Like, the big elephant in the room is the big bubble in the market, right?
Yeah.
I think it's pretty obvious to say that we are in a bubble. I think most people realize that.
Yeah.
But it's kind of feels irrelevant to try and like let that overshadow your decisions too much, because the whole thing with a bubble is you don't know how long it can last. Like, this kind of bubble can go on for years.
Yeah.
Really. So you don't want to like just not do anything and wait, and when it bursts then you have activity, because you're trying to time the market there, and it's just impossible. No one is able to do that.
And because the market is just human nature correlated together in one big, screaming mass, you're never going to be able to pick that in terms of when it's going to turn the opposite way, because you're basically trying to predict human psychology.
Yeah.
So you can't do that. So, I guess we want to talk today about how we're handling it, how we're approaching it, and how we're not sure if we're thinking about it the right way. It would be really nice if we could just approach it and pretend it's not even real, pretend it's not happening, pretend there's not craziness everywhere we look, and just pick stocks. But it doesn't feel rational to us, does it?
It doesn't, no. Well, yeah, I'd love to just like wait around for when like the tide pulls out and you can clearly see, who's naked and who's not.
Yeah, exactly.
And then take your pick from there. Like, I'm sure that time will come. We just have no idea when. So in the meantime, what are we doing? How are we investing?
And what is a bubble? And that's the thing. That's another question, is that there's been so many bubbles through history. From the tulips to the South Sea bubble, .com bubble, the housing bubble of the GFC. And obviously now we're in some kind of like, would you call it a crypto bubble? Would you call it like a meme stock bubble?
It honestly just feels like another .com bubble, like a tech-based bubble where everyone's like, well, this time is different from every other time because we've got AI and we've got, all these incredible technologies that are just going to advance the human race, like beyond what we ever think is possible.
Blockchain's going to, make everything decentralized. And
all I would say to that is, have you ever tried to like Bluetooth your phone to your car, like in a consistent way? Like, I think technology's got a long way to go before it produces productivity based on today's valuations of businesses. We're just not there yet. Like, maybe one day, but it's so true. Like, to put your brain in the proper mindset of where you should be right now, the easiest way to like get a bearing on reality is to look at history, isn't it? So like reading Richer, Wiser, Happier. Is that what it's called?
Yeah, well, Will and Green's new book.
Yeah. Brilliant. It tells you like the background stories of all these great investors that we all admire.
Yeah.
But it also, like, they are the great investors that we know of today. And they've done so well because they have survived.
Yep.
Right? They haven't taken part in these bubbles.
Yeah.
And they've played it safe and they've been contrarians.
Yeah, it's like that saying, there are old investors and there are bold investors, but there are no old and bold investors, because the reality is if you just get on every train, on every bubble that comes along, you might catch a few, but you're flying a bit too close to the sun and you're probably going to get burned and probably going to blow up.
Yeah.
So you just, that extra level of caution. I listened to that book together, it's fascinating how many of these people just seem so conservative. And these are people who've made like 15, 20% a year, which is amazing returns. And they seem like they're not going to make any returns because they're so conservative.
Well, 15, 20% returns over decades and decades and decades.
Yeah.
The point is they have survived.
Yes.
They haven't taken part in the bubbles. They've just kept out of it.
Yeah.
And they've remained with their strategies. And at times that's meant that they've traded, their returns have done worse than the market. They've been ridiculed by people. If they're running funds, people have taken their funds from them and said, hey, you're not part of this tech bubble. Look at what everyone else is doing. I'm going to go with them. And these great investors have just stuck to
their principles,
what they know.
Yeah. And
appreciated what's happened in history.
Yeah.
And this is just history repeating. And that's how they've protected their capital.
Yeah. Yeah, for sure. It's almost that, like, if you're an investor and let's say you're investing over a 20-year period and you don't have a period where you underperform during a situation of overvaluation, then you're not going to be one of these great investors, because they've all done that. Every single one of those stories in that book talked about, like, Mohnish Pabrai being down 70% in the GFC.
Yeah.
He's one of the greatest investors. If you understand the way he thinks and the way he approaches the world, he's definitely one of the best. Down 70%. And these are the kind of things that most people, would think, oh, I'm failing. But during a bubble, stepping away from it and being able to handle some underperformance, it seems like it's a crucial part of being one of the greats.
Yeah. And it's a point in time where you can't really compare yourself to the market because the market is being really irrational.
Exactly. So I guess, we're talking about, yes, we're in a bubble, but, the biggest question in my mind that most people are probably asking is, like, what is a bubble? How do you define it? Is it just a run up in price? That's probably a thing that most people think, well, if you look at the share price of, say, Google, if you're not taking into account any other bits of information, but just looking at that share price, it kind of looks the same as Bitcoin, or it kind of looks the same as like a hot stock, something really popular.
Yeah.
But in the reality, like if you look at the underlying performance of the business, well, that share price appreciation is justified, and that's fine. That's not a bubble. What a bubble is in my mind is when your fundamentals are stable. Like I always make the analogy of like a house is a good analogy. If you've got a house and your rent's going up at 2 or 3% a year, but your house prices are going up at 10, 15% a year, it's clearly irrational, and that clearly cannot continue because your underlying fundamentals is not improving. But with a lot of the things these days that are going up in value, there is no underlying fundamentals that you can hold to say this is what it should be priced at.
Not at the moment.
Not at the moment.
Not, according to us, it's not reasonable, the fundamentals that people are anchoring their prices to, even based on future cash flows. Like, it all hinges off the fact that, the Shiller P is at 37, right? Mm-hmm. People are basing today's prices on exponential growth in the future.
Yeah.
Now, it might get there in 10 years. These valuations might turn out to be based in reality on our future.
Yeah.
But that would mean that everybody in the market is happy to not take any returns or any increases in stock price until that point in time in the future when the values are representative of the earnings.
Exactly.
So, do you think all the retail investors who've just come on board the past year, you think they're going to be happy with their money in stocks that do nothing for the next 10 years until their value's realised and then they get their returns?
Yeah, exactly. I'll look at the Nikola SPAC. So that was an electric truck company that got, I think, a couple of $1 billion, in a SPAC. It was merged with this company and, it got listed. They're saying we're not going to have any revenue for 3 or 4 years. Are you telling me that all the individual investors in that company are going to be waiting for like 3 or 4 years contently? No, they're in it because they want to make a quick gain on the SPAC. And that is classic bubble behavior, like not focusing on the fundamentals, but focusing on what's, the price appreciation, basically.
Yeah.
And it's really important that you pay a reasonable price based on the current situation. I was just looking up on something I retweeted about a week or two ago that this guy, Andrew Kuhn, said Microsoft had a market cap of $393 billion and a PE of 53 in 2001. So, very expensive stock and something that's worked out. But if you purchase the stock in 2021 at that high price, PE of 53, Tesla's not even, if Tesla was a PE of 53, everyone would be saying it's a buy. And this is Microsoft, one of the great companies. Now, if you purchased that company in 2001 and held, you didn't break even until 2016, 15 years. And that was in a period of earnings were growing, everything was actually going really well in the business. But because you paid such a high price, for it, you didn't do very well for like a massive long period. So I guess we'll see what happens, but it's not looking good.
Yeah, well, I try and think of what people's mentalities are like at the moment in this current marketplace.
Yeah.
Would they be happy to hold on for 15 years until they see a movement in the stock that they hold? I don't think so. Like, we look at the liquidity that's been pumped into the market,
Yeah.
An extra $6 trillion. Like, we don't know if that's in the stock market or it's gone into housing or, cars and all these other areas. But I like to look at our economy, like the global economy.
Yeah.
As like a grocery store.
It's basically a big supermarket.
It's a big supermarket. And at the moment, you've got different shoppers in the supermarket, right? You've got your big funds who have to come in with like $100 notes. They can't buy anything for less than 100, right? Yep. So they're capped at that. And they're refined like a certain aisle of big brands of what they can buy.
Yep.
So they're stuck in a specific section.
Yes.
Okay. So they might think intelligently. They might know how to value stocks. They might be able to find opportunities, but they actually they're too big to really
approach the whole thing with a very logical investing framework. It's like, when you've got that much money, what can you do?
Yeah, they're kind of like hamstrung in a way.
Yeah, for sure.
And then you've got like this frenzied mob of like retail investors who are new to the scene.
Yeah.
Who are kind of coming in and buying whatever's shiny, whatever's got flashing lights against it. They're pushing up prices of these items that everyone else is going for, and they're just buying it because everyone else is buying it, and then it gets out of stock, and the price is ridiculous. And then you've got like your intelligent investors who just walk through the whole shop with their calculators, and they're calculating, is this a fair value? Is this a fair price? Do I want this item? What's the longevity of this item?
Yeah.
And you just kind of take your pick on what's available at the time.
Yeah.
And that's where I think we have this amazing opportunity.
As small investors? Yeah.
As small investors who are doing it intelligently.
Yeah.
And I don't think you're going to find your area of opportunity in the places that
the big guys are looking.
The big guys are looking, and also the speculators are looking.
Yep. Yeah, you got to go to the area of the supermarket where nobody is. You got to look on the top shelf. You got to look on the bottom shelf. You got to, don't look at eye level. Like, that's where all the average stuff is. You got to go high, got to go low. And, just because something's on special doesn't necessarily mean it's a good deal.
Yeah.
It's a perfect analogy. But it involves, not to mention the fact that you've got people with index funds who just have to buy the certain products no matter what happens. There's a ton of money coming in constantly into index funds still. I think, didn't we hear that it was like, it used to be 10 years ago, like 3% of the money was index, and now it's like 40.
Yes.
That is insane. You're telling me 40% of the market is just in there no matter what? They're not evaluating businesses, and they're not looking at management. They're not making any of those rational decisions. It's incredible. It's absolutely incredible.
You've also got like the added complexity of bringing credit into the supermarket. You know, these people can come in, they can pay with credit. It's not even their money.
And that's a classic sign of a bubble. When you've got huge amounts of margin lending. That was something else I retweeted out. There was like 8 of these charts, and they were all looking terrible. Like, they were all at record highs. But the biggest one that, triggered me was the margin debt. So the increase in margin debt is 2 standard deviations above the average. So it's a huge difference compared to usual. And it's now crossed a point where margin debt is exactly as high as 2007. And it's exactly as high as the year 2000.
Yeah.
So the last 2 bubbles, each time there's been euphoria that's also correlated with loads of your average people coming in the stock market. It's also correlated with people taking on debt to buy stocks. Surprise, surprise, the prices are higher because if you can borrow money to invest, prices go up. So it's a classic signal. The hard part, of course, is what do you do about it?
Yeah, what do you do about it? Like, you don't really want to try to be thinking about when this bubble's going to burst and what you do at that point, because that could take years. And especially because, you know, PE ratios are at their all-time high, apart from the housing market crash, where it was, I think, 44 and we're at 37 or something. Right.
Is that the Schiller PE?
Yeah.
And I think for anyone who's wondering what the Schiller PE, the PE ratio, if you're a brand new investor, it's just for example, so if a company has earnings of $1 million and you can buy the whole business for $10 million, then the company has a PE of 10. If the company has earnings of $1 million and you're buying the whole business for $20 million, the company has a PE of 20. So it's basically a relationship between the earnings and the price you're paying. And what the Schiller PE is it takes the earnings, it looks at the margins, the profit margins of a company, and actually normalizes those margins. So the normalization of margins is something that's always happened through history because of capitalism. So capitalism acts on margins to stop them from going too high or too low. But the Schiller PE corrects for the normalization of margins, but then it looks at the whole market and takes the PE basically of the whole market. And we're at record highs on that measure as well.
Record highs, yeah. So yeah, if it's not as simple as just saying, okay, well, it was the .com crash, where it was its highest of all time at 44.
Right. So we haven't reached that yet.
And also at that point in time, I think interest rates were like 6.5% or something. So they were quite high.
Okay.
So it's not as easy as just like looking at that chart and be like, all right, we're going to hit that. We're going to hit 44 and then it's going to bust.
Yeah.
Because with interest rates at basically nothing,
yeah,
that could probably be pushed even further before people are forced to think rationally.
And just looking at bubbles, I mean, the PE ratio of the market in Japan and the Japanese bubble got to 60 before it busted.
Yeah.
So if we were to get to that point, that'd be 80% or 70% higher than where we are now. But then obviously the Japanese stock market went nowhere for 20 years after that.
Yeah.
So,
that
it's
affected people's mentality. Like, do you think that was a mentality disruption for like the whole country?
I think so. Yeah. Yeah. Like what?
In terms of running back to safety and.
Definitely.
Yeah.
Yeah, definitely. It stuffs up, people's approach to things. And if you get in a situation where, the index hasn't made any returns for 2 or 3 years, well, what direction do you reckon those index fund flows are going to go? Are you going to get more people putting money into index funds or taking them out? And that's where you can see like an unwinding and a bit of a reversal where people go back into, buying actively managed funds or something.
Yeah. Again, I guess my brain works in analogies.
Yeah.
I just got to try to put it into like, when I look at the market as a whole, I see it also in terms of like storage sheds.
Yeah.
So you've got all these different categories of where you can store your wealth. And you kind of want to be ahead of the herd in a way. So you want your money stored in a shed that isn't overly populated at the moment.
Yeah.
Like it's quite empty.
Yeah.
But you can see that in future, people are going to start storing their wealth there. And when that gets, condensed, then you pull your money out and go to the next storage shed. Like in a way, I feel like we kind of have that in terms of our cannabis investment.
Yeah.
I feel like that's a great opportunity for future growth because there's just not enough people comfortable enough to invest in it at the moment. There's not the big guys who are allowed to invest in it at the moment. So it's kind of like this little niche that you can take your pick from quite good businesses who still have good fundamentals.
Yeah.
And if you understand like the legal landscape, then you can have security knowing that it's not going to be a total loss of capital.
Yeah.
Especially combined with, good management teams and all the rest of it.
Yeah.
But looking at like storage sheds, it's kind of a macro approach as like a background to how you would choose to invest.
Yeah.
Although it doesn't ultimately determine on a micro level which businesses we invest in. It's just kind of, if you can see a segment is being underappreciated, then look in that segment, look at that barrel of fish to shoot.
Exactly. Yeah, go looking in the areas where people aren't looking. That's your only advantage as a small investor, is to at least start applying your limited, brain power, limited resources, limited capital in areas where you can actually, try and get ahead of some of the big movements.
Still with some security though.
And still based on purely the fundamentals and, a bottoms-up approach. But just being aware of what everyone else is doing at the moment, which is index investing, quant investing, and your average retail investor coming in with margin debt to buy Tesla, cryptocurrencies, and hot stocks that have been going up. And these are huge danger signs.
Yeah. And that's not to say if you're invested in crypto or Bitcoin or Tesla or anything like that, that's not to say that is not going to work out for you in 20 years' time.
Oh, sure.
It very well could.
Yeah.
But at this point in time, when you look at the great investors in history and the fact that they have remained outside of those bubbles, outside of those speculations, and they've just focused on maintaining capital, protecting capital, investing really intelligently where other people aren't, and being happy with like long-term returns as opposed to short-term returns.
Yeah.
I think that's kind of the gravity we're holding to at the moment to keep our perspective.
Definitely. So, the way that we're trying to approach it is that we're still trying to buy anything that we find that looks like a great deal. A cannabis investment, EOS, one of our favorite companies, we've done a lot of work on. Howard Hughes is an incredible business with a lot of assets. It's not going to grow at 30% a year, but there's some security there in hard assets. We own Facebook, for example, which is still going to be a beneficiary of the huge trend towards digital advertising, versus TV advertising and all the other terrible kinds of advertising that just don't work. Facebook's going to be a huge advantage of that. So we're kind of positioning ourselves to benefit from a number of things that look unlikely to be different in the future, and no matter what happens, basically.
Well, it feels impossible to have a total loss of capital in any of those positions, because when you really think about what's the worst case here, is there a chance the stock could fall to nothing? The company could go bankrupt. You could lose all your capital. Is there a chance of that happening with any of your holdings? And if there is, well, factor that into the percentage that you're allocating of your portfolio.
For sure.
And honestly, I don't think I would invest in anything where there was a total loss of capital
potential
possible.
And that's another common thing from the book that we found, is that all these investors, they all focus on downside. They all focus on ways it can go wrong. And that's a common thing that humans don't like to think about. No. Humans don't like thinking about the ways that things can go wrong. And that's, where your advantage is at this moment in time. But certainly if there's so many signals that we're in a frothy time, we're in a bubble, and all you can do is just hold to those principles that those investors in the book have held to so successfully over the years.
Yeah.
So
be boring.
Be boring is the way to go.
Be the nerd. Be the value guy.
Yeah, exactly.
I don't know. I don't think we're really value investors, are we? Like, we're growth at reasonable price investors. Is that different from value?
Not really. I mean, it just depends how you define value. But I think that, value investing is just trying to buy any asset for less than it's worth based on the value of its future cash flows. So, however you want to call it. But we've definitely rotated away from things in the past that were just like, okay, it's $1 of value, we're buying at 50 cents, and the $1 of values, it might be $1.05 in 5 years' time, and trying to rotate away from that and more towards things where, okay, you're buying $1 of value for 70 cents, but the dollar is going to be $5 in 10 years' time. So that's where your security comes from. It's sure you want your margin of safety still, but you want that original, asset to be growing in value, and that's where you get the real security from. Because every year it's getting more and more undervalued, as you're owning it for longer and longer. So yeah, basically, you think that in a bubble the best thing to do is to hold cash. But we haven't really done that because we keep finding specific opportunities that would be fine no matter what.
Yeah, they're still out there.
Yeah.
Yeah. Yeah.
And that was the same in the .com bubble. Like we were listening to Jeremy Grantham earlier this week, and he was talking about how in the .com bubble, I think the S&P was yielding like 1.6% as a dividend, which is probably similar to what it is now. If you just buy the index, you get a dividend of 1.6% or 1.7% of your purchase price. But he said in that time period, you could have taken your money out of the S&P and you could have bought a real estate investment trust that was yielding 9%. Like, what a deal.
Yeah.
And...
But what did he say about that? No one wanted that because it was all about tech stocks at the time.
All
it's
that
like,
growth.
Why would you go into a REIT?
Yeah.
When you're going to miss out on these amazing companies that are going to 100 bag in a year or something. People had these ridiculous speculative dialogues that they were just spurting.
Narratives, yeah.
And it's no different today.
No.
It's just with a different asset class.
Yeah. It's that Mark Twain thing. History doesn't repeat, but it rhymes. And it's like, it seems very similar. I mean, I wish I was 30 years older so I could, go back, and I wish we were had that experience. But you gain the experience by hearing the experiences of people who are older than you, who have been through these periods. And when Buffett and Munger say, yeah, this is the craziest time we've seen, listen to what they're saying.
Yeah.
These are people who've been through these things 7 or 8 times, and to turn around, as some people I've seen say, oh, they don't understand what they're talking about. Give me a break.
Come on, man. Yeah. It's so different when you experience it to when you just read about it. We only get to read about it. But you have to have some humility and respect the fact that this has played out in history. We might feel like we're living in a special time.
Yeah.
With completely different businesses than anyone's ever seen in the past, but we're not really.
No, there's still the forces of capitalism still act on everything. Any company that earns a lot of money is going to attract competition. And that's just the way things are and the way things always will be. So those forces still at play, to turn around and say, well, this time is different, and, the growth's going to go on forever. Trees are going to grow to the sky. Crypto's going to solve all our problems. When my Bluetooth speakers, the 2 Bluetooth speakers that are supposed to sync to my phone every time, when they sync every time at the exact same time, I'm going to start to entertain some possibility.
Yeah.
That technology is going to save us.
Yeah.
There's
something to this AI, but not until then. So yeah, what we've done is we've got 7 positions. We're about 80% invested. There's a small put option position, a small gold investment that is acting as a bit of a hedge. But apart from that, we're sort of looking for incredible opportunities at cheap multiples that will do well no matter what. And we think for us that's the best way to handle it, is not to ignore the situation completely, but to be aware and not be involved in any of these industries and any of these businesses that are participating in the froth. Because if your investor base is people that are not educated and not in there for the long term, when things go bad, they're all going to be out the door into something else. So that's something to be aware of, I think. But you want to have some rationality surrounding where your money is.
Yeah, it's a fascinating time, that's for sure.
So I guess we're trying to stick to our principles always. Keep a acknowledgement there of the time in history that we're in.
Yep.
And the times in history where this is played out over and over and over again.
Yeah.
So reading about these awesome investors' stories, what they did at the time, is kind of priceless. But also, I guess the reason we're not holding a heap of cash as well is because there are a few opportunities around still.
Yeah.
But we're also, again, the macro backdrop, we're trying to keep in mind very low interest rates with inflation that's already kind of coming through.
Yeah.
In consumer spending, and
these are all the inflation risk is a huge one. But from what we can tell, one of the best things you can do is to own growing businesses. Growing great businesses, and that's a great way to protect against it. Which is kind of the solution to a lot of problems. Just having these great businesses, holding them,
It's better to be in businesses than in cash at this point in time.
Definitely.
But it really matters the price that you buy in at. And so, if you're buying in at multiples that are just not going to make any returns for you, even if it is a good business, then it's still not a good option.
Exactly.
Because we're all just trying to make good returns, aren't we? No matter the quality of the businesses. You got to have both.
Definitely. Yeah,
I guess we're in this environment as well. We're looking for businesses that are inflation protected in some way, so they have pricing power. If their costs go up, they can change their prices to suit
pricing power, and also cost control. There's another thing. If you're not in control of your price, so your pricing is going up, but you can be in control of your costs, kind of the same thing
in terms of like vertical integration within a company. So you control your
inputs and your outputs.
Perfect. And also a company with low debt or fixed debt for a long time. So they're not impacted too heavily by interest changes.
Interest rates going up. I think that's one of my biggest concerns for Howard Hughes, because they do have, some debt on their buildings, but, it's not a huge part of the business. And all their rents are, indexed to inflation. So they own some of the best real estate in America, from what we can tell, in terms of being in the higher socioeconomic classes and also in the higher income brackets as well. Their communities are basically like high-end communities. And within those high-end communities, they own great real estate, street-level real estate, office real estate, and all of those contracts that say, like, your rent's going to rise at, what do they usually have? Index to
CPI or something.
Yeah, index to CPI, basically. So as long as the underlying business that's paying that rent can sustain it, Howard Hughes is protected, despite the fact that they could potentially have, interest rates on their properties going up, but they can also hopefully raise the income from the rent to offset that. So they should be able to manage it no matter what, although it's not perfect. Not to mention the fact, the positive in that business would be that they have huge amounts of land, and land has historically been one of the best protections against inflation. To have a huge, fixed amount of something.
Yeah, it's a truly finite resource. Truly
finite resource.
It's like not even, materials that you mine from underground. Like there's really, you've got no absolute fix on those types of commodities, but with land you do.
Definitely.
I also feel like Air Wellness is like inflation proof. It's like the best option because they've got a loan at like 12% interest. It's like they might be the only industry, the cannabis industry, where they're actually getting access to lower rates than what they're currently getting.
Yeah. So like an average business right now, like, your Facebook or your Howard Hughes, they're borrowing at like 2.5%, 3%, 2%, in that range, depending on the risk, So if interest rates went up to 5%, well, Air's already paying 12. You could have interest rates for most companies going up, but as cannabis becomes more normalized and those banks get, some more laws get passed and those banks get more comfortable lending to the cannabis industry, they could be paying 6%, and that'd be amazing because they can buy businesses at 4 times earnings, which is a 25% return on capital. So this is all, like part of why we feel reasonably good about Air Wellness.
Plus, they're vertically integrated as well, so it's like they have full control over their costs.
Definitely.
But that's what we're doing amidst a bubble.
Yeah. I mean, anybody out there would love to hear what you think about that. Whether you think that concentrating, not holding too much cash, whether you think, if anyone's got a good hedge out there that's going to pay off 15 or 20x, for a cheap price, I'd love to hear about that. But we can't find anything like that at the moment. So keep looking.
Till the bubble bursts.
Till the bubble pops. Either way, I'm going to keep tweeting. Anytime I find something, I just tweet the word bubble.
Bubble.
And I just try and find an emoji that has the bubble, some bubble relation to it. So I'm going to keep doing that and see what happens.
Do you reckon that a lot of value investors have just started podcasts at this point in time? Because there's literally, we're twiddling our thumbs trying to find stuff to do. It's what can we do? Okay, let's just talk about investing. Let's start a podcast until the bubble bursts, and then I bet you any money the amount of financial podcasts is going to halve because we're all busy analyzing stocks and allocating capital.
Heads up to anyone listening, don't get too attached to this podcast, because if we get 25% pullback, these podcasts are going to go from once a week to once every 3 months because we're going to be doing too much work.
Hopefully. But read Richer, Wiser, Happier as well. Awesome book. Fantastic book.
Weaves together the stories of many different investors it's not even, it doesn't even go one investor per chapter. It goes kind of like, it starts with one investor, kind of pulls out those lessons, brings in some lessons from other investors who've been successful, all different approaches. Some are like more diversified, some are less diversified, incredible stories.
I knew Templeton was a weirdo though.
Yeah, strange guy. Yeah, very strange. There's that thing where I used to hear those stories about someone who's like a multi-billionaire and who never spends any money. It's like, what got a great thrifty guy. And now I think like, geez, man, just enjoy yourself a bit. Like, don't...
Yeah.
But he was a very religious guy. Like, and that's something that to hear him talk about that is very unusual because...
Yeah, that has kind of intrigued me a little bit because a lot of these investors that we've listened to their stories, they turn out to be like religious minded or come from a religious background that they still kind of adhere to in a way. And that strikes me as odd.
Mm. And why does it strike you as odd?
Because we come obviously from a religious mentality, a religious background. I guess maybe we're distorted in our view of religion because our background, it was like such a fundamentalist Christian, strict kind of
black and white
cult-like religion, right? Where like all of everything we learnt about and everything we did, all the decisions we made was so controlled and you weren't actually able to learn for yourself. Yeah. And so I think I've said before, like it's like your brain was in an isolation tank for like the first 25 years of our life. Yeah. Like it was only fed specific nutrients and grown in a specific way. Like it wasn't allowed to take on knowledge and figure things out for itself. Yeah. That's why investing is so like...
been so fascinating.
Fascinating because, it's all about being able to ask questions and investigate and come to nuggets of truth. And I feel like when you have anything that's a top-down system, like most religions are, then it's gonna stop you from asking certain questions. Yeah. And that doesn't fit with investing. No. Investing is kind of like a science. It should be in science. You can ask any question you want.
I think the only advantage that, being religious might give you as an investor is it does perpetuate a lot of negativity in a lot of fundamentalist religions. There's a lot of focus on like, what's bad and what can go wrong. And I think that can be useful in investing. Like if you're, you want to be optimistic, but you don't want to be crazily optimistic. You want to still have that kind of mindset of, okay, what can go wrong here? Is the world going to end? If you've been raised in any kind of Christian religion that's, pretty hardcore, then you're probably pretty familiar with, the possibility of like the world ending and, there being like a Armageddon style situation. And some of those, mindset structures can probably be useful for looking at stocks.
You're probably used to the feeling that like a big group of people who think differently to you could be wrong, and while you're right. Yeah. Like it makes you feel comfortable being the contrarian.
Definitely. Like I think we've talked about this, like about how, for the first 25 years of our life, we thought that everybody else was wrong. Yeah. And we were right. Yeah. Everybody else, in the religion that we were raised in, which was Jehovah's Witnesses, you believe that you have the one true religion, and you believe that everybody else apart from you is going to be, destroyed and killed in some kind of Armageddon style scenario. Yeah. And to be raised that way and to be told like, you're right, everyone else is wrong, you get pretty good at, handling being the contrarian. I think that's something that a lot of like really, investors in the book seem to be from like some kind of fundamentalist religious background, which gives you that you're okay with that mindset. You're okay with that idea that you're right, everyone's wrong, and then you come to investing, and that's actually useful if you get the facts behind you. That's what you got to get behind you.
Yeah, true.
Don't just believe that you're right, and everyone else is wrong. And if your whole assets are in Ethereum or something.
Don't go Cathie Wood style.
Oh boy, Cathie Wood.
But yeah, probably we have pulled a few things that are useful from that background, but ultimately I think it's a big negative on your thinking process.
Oh, for sure.
If you have anything that like stops you on a thought train where you can't go any further because your religious belief tells you this is the truth. Yeah. No,
it says that, if you keep asking questions and if you find out some answers that disagree with the answers that you've been given from the Bible or from the organization that you're a part of, if you ask some questions, you find out answers that disagree, well, your answers are wrong. It's not the religion that's wrong, it's your answers. If the two things don't add up, you got to pick one. And that's not a good mindset to bring to science or investing, because at the end of the day, you want to have the beliefs about a company or about, a scientific treatment that's actually true. But then, pretend you're in a religion so you can hold on to the investment for 10 years while everyone thinks you're crazy.
Yeah. But then I get some people like Aaron Edelheit, is that his name?
Yeah.
Where he has an approach, I think his religious mentality is for like his happiness and his...
pragmatic.
Yeah, he practices the Sabbath for his mental health, and having a healthy approach so investing doesn't take up your whole world. You know, there is more to life.
Definitely.
I understand how it can be helpful for that while not stopping you intellectually in any aspect of where you want to go with your learning and your questioning.
Definitely. And if someone is part of a religion where there really is open questioning and you really can find out things that don't disagree with your beliefs, I think that can be compatible, with operating well in the world. But it's a hard thing to reconcile. Like John Templeton seemed like a very religious, very dogmatic guy. Although they did mention in the book that someone once was talking to a lady and said that he thought that the flood or Noah's Ark was a lesson or an allegory. Mm-hmm. And then she immediately said to him, "Oh, well, you're not a Christian then." So he was even though he comes across as like very dogmatic, I think he probably still was able to
applies logic to everything.
Be flexible. Yeah.
Yeah.
Yeah, it's very interesting.
Yeah, it is.
If you got this far, thank you so much for listening. We really hope you enjoyed the conversation.
Now, if you'd like to become my 22nd
or my 43rd
follower on Twitter, links are in the show notes below. Mitch, anything else?
Nothing to add.